What are the risks of trading options? By www.options-trading-education.com. You can make money trading options, and you can also lose your trading capital. What are the risks of trading options, and how do you avoid them? The Options Industry Council discusses the benefits and risks of options trading. Most strategies used by options investors have limited risk, but also limited profit potential. Option strategies are not get-rich-quick schemes. Transactions generally require less capital than equivalent stock transactions. They may return smaller dollar figures, but a potentially greater percentage of the investment than equivalent stock transactions. Even investors who use options in speculative strategies, such as writing uncovered calls, don't usually realize dramatic returns. The potential profit is limited to the premium received for the contract. The potential loss is often unlimited. While leverage means the percentage returns can be significant, the amount of cash required is smaller than equivalent stock transactions. Buy call or put options and your risk is limited to the premium that you pay. Sell uncovered calls and puts and your risk could be extreme. Why is that? Buying options. Buying options on stocks has profit potential and limited risk. Buying call options on stocks results in profits if the stocks go up in price, and buying puts on stocks results in profits if the stocks fall in price. Buying options on stocks allows an investor or trader to secure his opportunity for a profit with only a small portion of the price of buying the stock itself. This investment leverage allows an options trader to spread his investment capital among several options investment opportunities instead of tying his funds up with a single stock purchase. Buying options on stocks also reduces investment risk, as the most a trader can lose is the price of the options contract. A common approach of beginning traders is to buy a call on a stock that they think will rise in price. The risk in trading options in this manner is that the trader might lose the premium paid for the contract, but no more. Selling options. Over the long term, options sellers make more money than options buyers. But the risk is such that options sellers need deep pockets to handle the occasional large loss. The one fairly safe manner of selling options is in selling covered calls. In this case, the seller owns the stock and takes no loss if the price goes up, and he or she receives the premium for risking the loss of the stock. But selling call options without owning the stock can be risky. The trader receives a premium for selling the call contract. This is his profit, so long as the buyer does not exercise the contract. If the price of the equity rises sufficiently, the trader will exercise the option in order to buy the equity. When this happens, the seller needs to purchase the stock at the current market price. However, he will sell it to the buyer at the strike price of the contract. He will lose money on the difference. In such a case of selling call options without owning stock, the loss for the seller is the difference between the market price and the strike price plus fees and commissions. If the equity rises significantly in price, the trader can lose a lot of money when selling call options without owning the stock. In the end, serious options traders employ strategies in which they mix calls and puts, buys and sells in such a way as to make a profit, limit their cash outflow, and limit risk. For more insights and useful information about options trading, visit www.options-trading-education.com.